All right, guys, I'm turning to the experts for this one. This is something that I think some of the viewers have been really asking us, and it's what makes a good investment or what makes a good deal for commercial real estate in general. Chase, could you start us out? What's one of the indicators in commercial real estate investing that makes a good deal for an investor?
So when we look at a good deal, we look at, there's a big difference between a vacant building and a full building. When you look at a full building, you want to look at the income the building has. And that's very important because you want to know what kind of return you're getting. Just like when you look at stock market, when you buy a stock, you want to know what kind of return you're going to get in the future. Commercial real estate, you can do the exact same thing, and we call it a capitalization rate. Another way of looking at it is a vacant building, and we use sales comps just as you would if you were buying a home. And then capitalization rate, we can go further into that, and that's where I refer to my senior partner, Dan Oster.
Yeah, cap rate is probably worth its own video, but cap rate really just describes the relationship between the income a property is producing and the sales price. It's in essence, how much am I going to pay for that income stream, okay? And there's both internal and external factors that make up cap rate. It's a little bit counterintuitive because the lower the cap rate, the higher the price is going to be. It's an inverse relationship. So if I take the same $100,000 of income on a building and I say it's a 10 cap, a 10% capitalization rate, I'm going to pay $1 million for that $100,000 of income. But if I pay a 5 cap on that same building, it's worth twice as much. It's a $2 million building. Well, what's the difference between a 5 and a 10 cap? Well, there's going to be internal factors. It's going to be how long is that lease? How much risk is associated with that tenant? Is this a one location mom and pop startup, or is it the 250th location of a regional or a national company? The risk associated with the credit of that tenant affects cap rate. You're going to pay a lower cap rate for a company that has bigger income and more locations most commonly. Okay, so those are internal factors, but there's also external factors that are outside of the control of the building. If I were magically to take the exact same building that sits in downtown Reno, Nevada, and I were to drop it, say, on Main and Main in San Francisco. Well, San Francisco has, the Bay Area is a 20 million person MSA. And so the same building, same income in that location is going to sell for a lower cap rate. And the rationale is that it's less risky in that location to replace the income should that tenant move. So when we talk about cap rate, it's both the features and the attributes of the tenant that's in it, but also the market in general. And that's why Reno right now is actually experiencing what over time we call cap rate compression. Over time, cap rates are coming down in Reno, and it's because people's perception of this market is really evolving and changing in a very favorable way. We're seeing more income growth here. We're seeing more population growth. People are deciding this is a great place to move to, and that's helping the investment community look more favorably on Reno's sort of external factors when they're considering cap rate and what they'll do. Chase brought up a great point earlier about lower interest rates right now. That also is contributing to long-term cap rate compression. You can borrow money for less. That allows you to pay a little more for that same income than maybe you would have when interest rates were 2, 3, 4 basis points higher. So cap rate is, it's a mathematical operator, but we talk about it as if it's its own thing. But I always think it's good to bring it back to cap rate just describes the relationship between the income on the property and how much I'm willing to pay for it. And it has both internal and external factors that really, in the investor's mind, dictate what they're willing to pay as a cap rate for a building.
Awesome. And you adhered a little bit to risk based on the location. What about risk based on the tenant or the multi-tenant, or would you consider a multi-tenant building, for example, better than a single-tenant building? If you're looking at it from the investor's standpoint.
That is a great question, and it's kind of like asking somebody what's beautiful. Some people think a single-tenant investment, where there's one tenant, I really understand that tenant deeply, and I do a real deep dive on their credit and their company, and if I'm comfortable with that credit tenant, I'm willing to pay a really low cap rate. Chase, you have a great example of a group that you've worked with in that way. Single tenant buildings, what are some of the reasons people have been buying those single tenant net lease investments from you?
So we're in the process of closing our 5th escrow on another dental office. It's the largest dental provider in Northern Nevada, and the reason that everybody's interested in these single tenant net leased investments is because they show security. They're a dentist, everybody has teeth, they can look at their finances, they own 30 buildings, they're well diversified in the market, and they're going to constantly pay their rent. And that's very important to investors, especially somebody that's putting their retirement into a commercial real estate investments. And then they're signing on top of that a 10-year lease with generally 2 5-year lease options beyond that, because they're planning on staying in the building for a long time.
Yeah, so from that investor's point of view, that single tenant is really secure in that space, likely to stay there.
Mm-hmm.
That means that there's less risk they vacate. There's more certainty you're going to get the cash flow you're counting on.
Mm-hmm.
So people tend to pay a lower cap rate, which equates to a higher price for that same
Mm-hmm.
building. But I've also had people say, hey, listen, I like a multi-tenant building. Why do you think a investor might prefer a multi-tenant building?
To me, I would say because there's less risk in one single tenant or in multiple tenants leaving your building. If there is one single tenant in the building and they left, you have a completely vacant building. But if you have multi-tenant, then you're kind of risk aversing that building and that property.
Yeah, that's a great point. So I might lose the profitable portion of that cash flow because a tenant's moved out, but I know I can pay my mortgage, right? Because there's still other tenants in the building paying. The other thing that people really look at when they're choosing a multi-tenant investment tends to be, what are market rates? So if I buy a building that has 5 or 10 tenants in it, the likelihood is that each one of those tenants is going to have a different expiration date. Okay? So as market rates go up and down over time, the hope is that you're going to have tenants that are going to vacate at a time when I can push the rents higher than what that previous tenant was paying. And if I have multiple tenants coming up, then there's more opportunities for me to capture that rent increase when it's available to me as a landlord. That's one of the things that's difficult about commercial real estate is we only get a few opportunities to change the terms of a lease. It might be 3, 4, 5, or in Chase's case, 10 years between when a tenant's lease is committed to and when the opportunity to renegotiate those terms come up. In a single net tenant leased environment, it's going to be really hard to change the terms of that lease. But if I'm in a market like Reno, Nevada, where we're seeing a lot of appreciation in buildings, and I buy a multi-tenant, the opportunity I'm going to have to make that investment match what market rents are, and therefore achieve new value add sort of milestones, it's just much more frequent that I'm going to be able to renegotiate that lease and capture that market appreciation that's going on. And in those cases, you might prefer a multi-tenant investment. Those are just a few of the reasons why cap rates change over time. If you like this and other investments or other insights into commercial real estate, please hit the subscribe button below. If you have questions specific to commercial real estate that you'd like us to tackle from our perspectives, go ahead and leave them in the comments. Thank you for spending some of your valuable time with the NAI Alliance Industrial and Office team.